Now, Abhay, the other piece is what's happening with, the underlying force behind any kind of GDP growth. GDP numbers came out maybe slightly below, but maybe partly anticipated. But when you look at the credit growth, is it pointing towards an issue, or is it that just looking at banks' credit offtake may not be the right way to look at it, simply because the street is not necessarily borrowing only from banks? I'm just trying to understand, how do you think of this and the bank's credit growth data that has come in from a growth perspective, and then from a financials perspective? Do you can therefore keep the banking exposure to a minimum, look at non-lending financials? Tell us how you think about this.
So Neeraj, I think the data actually, what has come over the last week especially, has been very consistently pointing to a slowdown. And this slowdown started about the time when RBI started squeezing or putting more risk mitigation measures for banks. They increased risk weights for unsecured lending by banks. They increased risk weights for NBFC lending by banks. Even for housing finance companies, the risk weights have gone up. Plus, a lot of constraints have come up on peer-to-peer lending. So as a result, what has happened is that the money has become not as easily available as it was last year for any kind of borrowing, especially on personal loans, credit card loans. Secondly, so that has led to that increase in cost of borrowing has led to a slowdown across the board in credit, and that number is showing now. Second, what that has also done is led to a demand slowdown at the main street level. So when we recently did our channel checks, we found to our surprise that there is absolutely no inventory buildup for discretionary expenses, discretionary purchases for this festive season. You have auto inventory, which is worrying the retail and the distributors. There is no inventory buildup in paints, in tiles, in other stuff that people would typically spend money on during the festive season. So clearly there is a demand slowdown for discretionary expenses, again driven by the high cost of money. And that is again reflecting in the GST data, if you saw, was up net of refund only 6.5%, whereas the government estimates were much higher. So I think GST data gives you a good idea of what is happening at the underlying consumption level in the economy. And if the GST collection slows down, that is a very solid hint towards a short to mid-term slowdown in consumption in the country. So I think these, and then you have the other issues related to banks, since you asked that. Our view on lenders, generally banks and NBFCs, is that there is the peak cycle of margins has been achieved probably 6 months ago. And now the cost of money, cost of deposits is going up. Deposits are more scarce to get. Cost to income ratio is going up across the board. We're seeing because of higher rentals, attrition, salaries. And then you have higher NPAs kicking in. Collection efficiency has down from 98% to 94% for microfinance industry. So there is struggle on all aspects for lenders, including banks, private banks, public sector banks, and NBFCs. So in that environment, I don't see how for next 6 months or a year till the cycle reverses again in the favor of these banks, investors would expect to make money off lenders. I don't think there is going to be a multiple expansion, because the multiples are still the highest in the world, for our banks. So I think that is why we are negative on banks for the next 6 months to a year till we see again the margins going up. But right now we don't have any visibility of that neither.
Okay, and therefore, Abhay, then my counter question is, so you don't have to keep a exposure to financials, but or non-lending or lending, but are you exposing yourself to non-lending financials? There is insurance. There's also the wealth managers, which seem to be doing well on a quarter-on-quarter basis. The numbers are looking solid. Do you like the non-lending space?
We like the non-lending space, Neeraj. So I think there are three bets that we already have there. One is, which has been with us since post-COVID, which is what we call capital market infrastructure players, CDSL, CAMS, Angel One, because if the capital markets have to grow, which they will grow, these companies make a lot of money just, because they're basically tech companies that are benefiting from the macro investment theme. So, and these CAM, CDSL, Angel have already done very well for us, so, and we continue to hold them as per our model portfolio allocation. The second part is, which is more recent, about 6 months ago, is the insurance players, because we saw a long sideways correction in health insurance companies, in general insurance companies, and in life insurance companies. And after doing a lot of research, we finally placed our bets. And this is not by recommendation, but our model portfolio is known in the market. So we have ICICI Pru, ICICI Lombard, and Star Health in our portfolio, because we think that this is a space that has been ignored by the investors, and finally the regulator is getting more friendly. There will be launches of more innovative schemes, better risk coverage, and the valuations are quite attractive again by historical standards. So looking at that, insurance is a space we are quite bullish on. There are near-term triggers, reduction in GST. We are hoping it happens, but we are not banking on it. If that happens, I think the whole space will re-rate pretty quickly. And the third, as you said, is the wealth managers. I think that is a space, again, that will grow pretty rapidly. Valuations are a little unattractive right now, so we'll probably wait for better valuation levels to make a bet there, Neeraj.
Interesting. Okay. So, well, that's the sense of the broad